Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Tuesday, November 26th, and we're talking jeans. I'm your host, Nick Seipel, and today I'm joined by Motley Fool contributor Asit Sharma via Skype. How's it going, Asit?
Well, it's going very well, and I'm very excited to talk denim with you today, Nick.
Yeah, just for our listeners to note, we're pre-recording this episode on October 29th, so some facts may have changed between now and then. But yeah, really excited to talk about denim and jeans. I mean, when you think about fashion, there's really not a lot of articles of clothing or pieces of fashion that really have the staying power that jeans have. And they've really, in the past year, really picked up some attention of Wall Street. So, jeans were invented in the 1870s by Levi Strauss and Jacob W. Davis. And since then, as I said, they've become a fixture in American fashion, really ramping up in popularity in the 1950s after James Dean wore them in Rebel Without a Cause. But they aren't just fashion, they're big business. And as I mentioned, over the past year, they've really caught Wall Street's eye. Levi Strauss IPO'd earlier this year. We've seen spinoffs of Kontoor Brands, who's the maker of Wrangler and Lee Jeans, away from VF Corp. And we've seen a spinoff of Madewell from J. Crew. Asit, just off the top, why is there all this interest from Wall Street in jeans all of a sudden?
It's an intriguing question, isn't it? As the market has gradually crested ever since the Great Recession, the IPO market has become more and more intense, and you see these very valuable unicorns, private companies with billion-dollar valuations going public, and some of them doing quite well. So why are Wall Street investors still interested in jeans? I mean, there are a few reasons. One is these companies have extremely dependable growth. You mentioned Levi Strauss. That company has been around, as you said, since I think it started in the 1850s. Jeans were only invented 20 years later. So this is sort of a recurring revenue stream, and Wall Street loves nothing more than a recurring revenue stream. If you think about software as a service stocks, those are really hot now, but those are essentially sort of the same things. They're selling the same products over and over again, and people are re-upping every year, those software subscriptions. This is that, but in denim. Also, these companies, Levi's and Kontoor Brands, the first two that we'll talk about today, they throw off a pretty interesting dividend, a lucrative dividend, each of them. We'll get into the specifics a bit later. The third thing that I wanted to mention is that if you are an IPO investor, let's say you're a hedge fund or a pension fund or a retail investor, you've seen in the last year that for every hot issue, there's an issue that inevitably burns a hole through your pocket. Look at Uber, look at WeWork, which actually pulled its IPO because it couldn't come to market. So Uber might be the more specific and better example. But for every unicorn that does well, you're sort of rolling the dice as to whether these companies with their new business models will make money. So this is a great way, if you invest regularly in IPOs, to hedge those bets and put money in an issue that might not storm out of the gate, but over the years will return you, a handsome bit of money. And the last thing I want to mention is we rarely get a chance to invest in iconic brands in the consumer goods world. So between these first two companies that we're talking about, Levi's and Kontoor Brands, you've got the Levi's brand, you've got Dockers, you've got Lee Jeans, you've got Wrangler. So these are brands that have been around for decades, much beloved, extremely strong, great customer loyalty, and we look for that in the IPO market. Hey, what is this company bringing in terms of brand potential and brand value? So when you get a chance to put some money behind these in the public sphere, that's very persuasive reason to invest.
Yeah, I mean, as we mentioned, it's very rare you see a brand that has the type of staying power that Levi's had. And when we were doing some preparation for this show, you kind of compared it to Coke a little bit, in that both of these companies have been around since the late 1800s. Both of these companies are in a market that has really been durable over, since that entire period of time, and have had steady above GDP growth that has been able to continue over time, which is one of the things that we've mentioned is really attractive to Wall Street, is this kind of annuity-like business model that's durable over time. Do you want to kind of break that down a little bit, Asit?
Sure. So when Kontoor Brands actually made its registration statement, provided details before it spun off from VF Corp, which holds brands like Timberlake and Vans shoes. We got some good data on their management's estimate of the market, and per their estimate, jeans is a $100 billion market globally. And this company itself holds about a 3% market share. The interesting thing is that Kontoor Brands sees that this market has been growing steadily at a compounded annual growth rate, or CAGR, for about 4% for the longest time. And it's projected to speed up a little bit over the next few years to a 5% CAGR. And this is something, Nick, as we were batting around this topic, you pointed out that, hey, that actually exceeds, if you look at global gross domestic product, or GDP growth over time, that's somewhere around 2%, 3% at best. So you have an industry here which is steadily growing in excess of 2 to 3% of gross domestic product a year. And what that means is that it's staying slightly ahead. Consumers have that much more to spend, and they consistently buy these products. Again, what does Wall Street love? They love an annuity business, a business that you can depend on those returns every year, year in and year out. A lot of the sophisticated valuation models behind stocks that we love, be it Amazon.com, Microsoft, in the consumer goods sphere, I'll throw out McDonald's in addition to Coke. Most of the big institutions that keep pouring money into these stocks are thinking about future cash flows and discounting them back to present value. So Wall Street loves nothing more than a company in which you can predict the certainty of those cash flows going forward. And that's what's one of the things that's so interesting to me. Just to talk a little bit more about these first two companies, Kontoor Brands and Levi's. Kontoor Brands has roughly 3% market share of that, close to $100 billion. So it's got about $2.7 billion in annual sales. And extrapolating those numbers to Levi's and its own revenues, which are about $5.6 billion a year, it's got 5% market share. So that's not really a lot. Now, I know you add that up, it's 8% of the total global market. And yes, these two companies are dominant, but they've got a long runway to actually grab even more market share. And just briefly, Madewell, which has put out for its own IPO, not really an IPO, sorry, to spin off from its parent company, which is J.Crew. This company, the total company, has $2.4 billion in annual revenue. Madewell itself has about $615 million in annual revenue. So it's much smaller than either of these other two companies. By that criterion, it's got about 0.6% of total global market share, and it also has a very long runway to grow.
Yeah, another thing on the jeans growing faster than GDP, I think they kind of stand out as a piece of apparel relative to the rest of the market. There just aren't that many fashion trends that persist over the better part of a century, and the market really likes predictability, as you mentioned, in these annuity type businesses. And when you have a track record of in excess of GDP growth over decades and decades that you can extrapolate into the future, in addition to a very strong brand like Levi's, or as we mentioned, Wrangler and Lee, there's a lot of opportunities there. You mentioned Madewell. That's a little bit of a different animal there. A lot faster revenue growth, a lot younger company. Actually has a little bit higher profit margin, so a 10% net profit margin, around the kind of mid-sixes for the other two. And their model is much more growth focused versus those dividend models of those other companies. Actually, and they're less jeans focused than the other companies as well. A little over half of their revenue is attributable to items like T-shirts, footwear, leather goods, quote unquote, everything you wear with jeans is what they describe that as. One other place where Madewell is differentiated from Kontoor Brands and from Levi's is in its distribution model. So a lot of folks, when they think about buying Levi's or buying Wranglers, they think about going to your local Macy's or your JCPenney's to buy these products, and that, there is some concern about those slowing down. Well, Madewell, as a younger, newer, more millennial-focused brand, has this much more direct-to-consumer focus. We've seen the perfect example of that recently has been Warby Parker, a company that really is focused on direct-to-consumer, been able to build out from there. 87% of Madewell's sales are direct-to-consumer, and so that and 40% of their sales are e-commerce. So really a different approach from those other guys. Asit, can you talk about what kind of advantages that direct-to-consumer model gives to Madewell and what flexibility maybe it gives to the company?
Yeah, so if you think about how Levi's and also Kontoor Brands, their big brands, being Lee and Wrangler, how they've grown. They've grown through the mass market over decades, and this is from the time that malls were big in American culture. So you'd go to the mall and buy your jeans, and still they have a wide, what we call wholesale presence. And wholesale really means they are selling their jeans through retail channels. So when you hear us say wholesale, we're really talking about, at the end of the day, those jeans are being sold in someone else's shop. And that is a sort of tough model over time as the retail landscape evolves. And, listeners, you've heard us talk umpteen times on this show about how malls are dying out, the retail landscape is changing. The advantage you have in a direct-to-consumer channel, and what this means for Madewell, it's got about 135 stores. That's a rough number. Nick, maybe you can correct me a little later, but let's say it's close enough for Jazz. With these stores and with its e-commerce sales, as Nick told you, they reach most. This year, I think they're tracking closer to 90%, of their sales through these direct channels. And what advantage that gives to them is it's a tremendous builder of loyalty. When a customer is coming directly into your store or they're buying online from you, you have a great opportunity to enroll them in your loyalty program. And about 60% of the direct sales that Madewell generates ends up snagging loyalty customers. And these customers are responsible for about 67% eventually of all direct channel sales. So people who visit a store or buy online one time, about 2/3 of those are buying again and signing up for the loyalty program. So you really can capture that customer versus Levi's, which, although it's a really hugely strong brand presence, it still does compete on price. And, this is anecdotal, but, for me, when I was a kid in the 70s, I don't want to say what part of the 70s because that'll maybe age me too much, but you had to come to school in Levi's jeans. Wrangler was like the off brand. And Nick, we were talking yesterday, Wrangler, by the time you were in school, I think was a little more cool. But, there were times where my mom would take me to the mall and she'd be like, we can't afford all Levi's this year, so this other brand is on sale and I'm going to buy some of that. So when you're not in a preponderance of direct channels, you are vulnerable to this type of pricing. So that's the main thing that you get out of this. And I would also say that this sort of millennial-friendly aspect of Madewell that Nick talks about, it's a very persuasive way to go about the business, and it's led to this very fast revenue growth. They have a design team which actually crowdsources some of the designs with about 4,000 customers who have done 125,000 product reviews. So it's a very hip and online brand, both in the way that they sell, but in the way that they interact with their customers.
Yeah, Madewell, very controlled distribution with that, 130 so stores. You compare that to Levi's. Their products are in 50,000 retail locations, 3,000 dedicated stores and shops within shops. So obviously much more exposure to the broad retail market. As a result of that, their Americas revenue declined 3% in this most recent quarter. The Levi's management has called it, quote unquote, a melting iceberg. So something where, this is a big market, but slowly over time, this business is slowing down a little bit, at least in the U.S. And we'll talk about international maybe a little bit later and what opportunities there might be there. But as a result of that, also, one other thing to mention with Levi's too is that it's a little bit more premium product on in the jeans market, so maybe a little bit more exposed to the department store market. But as a result of some of these concerns with their traditional distribution outlets, we've seen both Levi's and, to a lesser extent, Kontoor Brands try to push into the direct-to-consumer market as well. 35% of Levi's sales are direct-to-consumer, Kontoor Brands 11%. Can you talk a little bit about what Levi's and Kontoor Brands are trying to do to build out this direct-to-consumer model and what opportunities it gives to them as retail is changing?
So for Levi's, it's more of a process of building out their own branded stores. When they do that, and these are mostly the shops within shops that you mentioned. So when they do that, obviously it's more like the Madewell model where they have a chance to interact on a more close basis with the consumer. For Kontoor Brands, it's interesting because, as you mentioned, they only have 11% direct-to-consumer sales, and they don't have a retail presence of their own. Now, this company happens to be headquartered in Greensboro, North Carolina, which is a stone's throw from where I live in Raleigh. And they're testing out a prototype retail store in Greensboro near their headquarters. And I wouldn't be surprised to see them roll out more of this in the future because, with their very well-known brands, they certainly have an opportunity to in higher or more affluent markets, in sort of outdoor retail centers that are becoming very popular, they have obviously an opportunity to exploit that. But I also think that, as they expand geographically, which is the second way to counter this type of U.S. Mall-based declining sales quandary, I think that Kontoor Brands has a huge opportunity to not only expand its direct business, but in general to sort of grow into a new business. The parent VF Corp never really helped this company grow to its full potential. That's not the fault of VF Corp because they have a gazillion brands. But when you're under sort of a centralized control, you only have so many resources that you can use to further your own growth. One of the markets, of course, they're looking at is China. And I was pretty surprised to learn that Kontoor Brands had never been sold in China. And now that they've spun off in May from VF Corp, they will have that Wrangler brand in China in early 2020. They're shooting for January, which is both an indirect and a direct e-commerce opportunity for them. So lots of potential there for both companies to wend away from the small-based decline. Again, it's more e-commerce and it's also geographical expansion because outside of the U.S., in developing countries, malls are all the rage, and that's really actually a place you want to be selling within.
You mentioned how Kontoor Brands management has called out that they really kind of felt hamstrung by the relationship with the VF Corp, held back their ability to invest in product innovation as well as international expansion. You mentioned pushing into China there. When you look at the opportunity outside of the U.S. For these companies, Madewell doesn't really have much of a presence there, but they mentioned a number of times throughout their S1 that they would like to continue to expand more internationally. But when you look at the opportunity for these companies to expand overseas and just the way jeans resonate outside of the U.S., how big of an opportunity is this for these companies?
It's tremendous. So Kontoor Brands is interesting because it's actually got a supply chain that stretches across North America and into Mexico. And so, when we think about overseas for Kontoor Brands, that might mean also just expanding, southward to a very big market. Let's talk about Coca-Cola again. That it's sort of a counterintuitive idea, but Coke has a big customer in Mexico, in the Mexican consumer, and has spent a lot of resources over decades. And it's worked out for them because their costs to supply to Mexico are a lot cheaper than supplying overseas. Of course, they've built over time their distribution within these markets, but the same principle can apply to Kontoor Brands. And I think that for them, that's a tremendous opportunity. Their global exposure is just 22% right now. So obviously the opportunity for them is probably greater than it is for Levi's. Levi's has about 55% of revenue in the US, 29% and 16% in Asia. But interestingly,
29% in Europe?
It's 29% in Europe and 16% in Asia. But for those of you who are not geographically challenged like myself, you'll notice, well, what about, the Middle East and Africa? Levi's includes those two big geographical regions within its Asia count. So 16% is actually just a green field for them to plow in the future. And with developing economies, not just in China, but if you look at economies such as Indonesia, Vietnam, Japan, looking in Africa, South Africa, Kenya, and moving on into the Middle East, those are very wealthy economies. They have a lot of ground, as I talked about at the outside of the show, to capture another few percentage points of market share. And for Levi's, what does another percentage point of market share mean? It means about $1 billion of revenue each year. One thing that I think, Nick, you were talking about yesterday is that when we were kicking around our preparation for this show, that the company's seen really global direct-to-consumer growth that's hit the double digits for a while. So not only is Levi's expanding outside the U.S., but it's doing it more in the direct channel. That channel is growing faster than the overall business. So you sort of get a 2-for-1 there in Levi's potential.
Sure. I mean, we've mentioned that, America's revenue was slowing slightly, but when you look at overseas, Europe growing double-digit rate, Asia near a double-digit rate. You mentioned the direct-to-consumer market growing. Appears to be a strong opportunity for them there. And, an opportunity to push that direct channel higher margin business as well. Another opportunity for these companies to take share and to grow their business is to push out to new customers. And for Levi and Kontoor Brands, I think that means expanding more into the female channel. Madewell, kind of the other way, need to push into men's products. When it comes to Levi's, what moves are they making to try to attract more women to their brand and to expand their market in that fashion?
So Levi's is doing two things. One, they are emphasizing that they've got a core discipline in men's wear. So it's sort of like owing both your strength and your vulnerability. Men's wear and men's bottoms each account for 60% of revenue. So while Levi's doesn't disclose what that final number is, that is how much are men's jeans the real driver of the business, you can sort of cross-section those two numbers and see it's a pretty big percentage. And so they're emphasizing women's fashions, and that actually moves into accessories. Not to say that men don't have as great fashion sense as women, but we don't tend to accessorize at the pace that women do, and Levi's has been very savvy in growing that. And also, they have moved one other area to sort of diversify away from this men's jeans core of their business is to look at tops as being a slice of their market. So they are heavy into T-shirts, jackets with different substrates, different cloths. And they're also cyclically pushing the jean jacket. And I wanted to stop right here and ask you, Nick, have you ever owned a jean jacket in your life before? Because my personal theory is they come way into fashion and then you wouldn't want to be seen dead with one.
Yeah, so I have owned a jean jacket maybe back when, middle school days. I never got into the full-on hipster thing. If I was leaning into the hipster culture, that's more of the jean jacket scene these days. But what about you, Asa? When's the last time you put one of those on?
So when I was a teenager, so this is, again, I won't tell what part of the 80s, but in the 80s, my sister bought me a jean jacket, and I think I was recently talking on this show about my sister being a fashion maven and myself not having much of a sense of fashion. So, she got me a jean jacket and she's like, you got to wear this every day. And I think might have been 10 years later, I met up with her. We had both moved to different cities and I was wearing that jacket and she's like, what are you wearing? I said, but you bought this for me. Doesn't this look great? No, it was much out of fashion. So I think that Levi's is aware that the jean jacket is a tremendous seller and it's a lead-in for other articles of clothing. But if they had their druthers and if Kontoor Brands had its druthers, the denim jacket would be in fashion all the time. Sure. But what a great piece of wear when it's hot and something you wouldn't be caught dead in when it's not.
Exactly. And just to throw a couple of numbers at you, Levi's calls out 17 consecutive quarters of expansion in women's clothing, 11 consecutive quarters of double-digit growth in women's lines. You compare Levi's having 69%, a very nice 69% of their revenue coming from bottoms. You compare that to Madewell, as we mentioned earlier, 52% of their revenue coming from tops or coming from T-shirts and those sorts of things. Kind of maybe draws the line into that gender dynamic between those companies. Obviously, a big opportunity there for Levi's. Kontoor Brands also doing some product innovation there when it comes to women's products. They've announced this Lee Jeans Body Optics line, which uses materials research, imaging technology, and insights from cognitive science to use fabrics that are more visually appealing and attractive for wearers. So that's a really big opportunity for both of these companies. Another area that a couple of these companies are pushing into is this ESG recycling, taking care of the environment push. Madewell in particular has touted that at the very front page of their S1. They tout 600,000 jeans recycled, turned into 100 million square feet of housing insulation. Asit, with these companies pushing in towards this ESG sustainability type focus, what opportunity does that create to kind of drive customers, particularly the younger generation, to their brand?
It's a sort of a double-edged sword. So I used to think that, hey, it's wide open opportunity, but there's a cost to every initiative that you undertake, and we don't really always understand the economics. And I'll give you one example. So Kontoor Brands has developed a really cool, innovative strategy for their jeans in that they're using foam now as a dye instead of using a water-based dye, and that saves them, tremendous amount of waste. It uses zero water and is supposed to reduce waste by 60%. But we really don't see those play out in the financials until years have passed. But these companies are erring on the side of the younger consumer, that this is extremely important to building lifetime value of a customer who's maybe in their 20s, is a socially conscious millennial, maybe versus a baby boomer. Not to say that baby boomers aren't sustainably oriented and environmentally conscious, but as a spectrum of consumer, they've been shown in studies to be a little less concerned about the provenance of the items that they use, and a little bit less attuned to these socially conscious issues. So long term, it's a win. I mean, it's a win for the environment. It's a win for these companies in the sense that if they pick up a customer in their 20s and prove to them that the customer can feel good about buying the product, they'll have that customer for decades. And it's a win for their bottom line eventually. But I think from now on, when we talk about ESG issues with consumer goods companies, we should recognize that there's a near-term cost. Anytime that you adjust a supply chain to make it more sustainable, there's a near-term cost on the financials. Now, this is just a personal preference. I'm all for that. I don't mind if a company that I invest in takes near-term hits in terms of gross margin or ultimate profit margin, if I know that eventually they're going to do better by the environment. I'm, maybe a little bit on the more sustainable part of the spectrum in terms of where I've evolved. However, I'm also, a business person, and I hope to be, over time, a savvy investor. I'm still on that journey. I want a company to be able to do that in a fashion that also is easy on the bottom line. So there is a trade-off there. I want to give more of an honest answer than what used to be an enthusiastic response to a question like that, Nick, which was like, yeah, it's great on all fronts. Everything has a cost, but in the end, I think these companies will win by grabbing consumers for a long, long time.
Sure, and linking the sustainability to driving sales, I think Madewell has an interesting approach there. Only 12% of their denim sales to shoppers are through their recycling program. But if you do participate in their recycling program, they'll give customers a $20 discount on a new pair of jeans when they recycle a used pair. So you can see psychologically, you feel way better about yourself going to buy new clothes, even if they're kind of expensive clothes. If you can say, hey, I'm taking care of the environment by recycling my old clothes, plus I get a $20 discount, you can see how that could maybe build a little bit of loyalty, as well as maybe drive more trips to the store than may have happened otherwise. The last thing I want to talk about here when it comes to jeans, and this is more, an assessment of the broader market. I talked about off the top of the show, what's been really remarkable about jeans as a fashion item is that they've been able to persist, over a number of decades and really be a staple of what people wear. And we're seeing in recent years this rise of this athleisure trend. Really started a few years ago when yoga pants started becoming just a phenomenon. I remember when I was in college, you really first started to see them pop up, and then it went from the college-age folks all the way up to the grandmas and the mamas and all that stuff. And now it's a phenomenon. Lululemon, this company that maybe nobody had ever heard of a decade ago, now a massive player in consumer goods. But with this growth of athleisure, do you think there's any risk that as more athleisure clothing becomes part of our day-to-day wear, that maybe some market share could be taken away from jeans, and that in excess of GDP growth may come back towards GDP?
There's some risk in it. So just some thumbnail numbers. It's really hard to get a sense of how big the athleisure market is. I've seen estimates that peg it at $83 billion annually to $200 billion annually. So by some estimates, it's a little bit smaller than the jeans market, and by some estimates, it's twice as big. But you have to remember that also includes things like socks and sports bras and accessories that go with this whole athleisure concept. It's not just leggings and yoga pants, which are the primary competitors to bottoms in the denim market, i.e. jeans. So there is a potential for this to shave a few points off of the market for jeans. I personally think that the two can coexist. If the athleisure market continues to grow, and some estimates peg this, actually a firm I respect called Technavio, they peg that this market is going to grow at a 7% CAGR. So we talked about the jeans market speeding up to a 5% compounded annual growth rate. So this is 2 percentage points above that for the next 5 years is what Technavio estimates. If it does continue to grow like this, sure, it's going to shave some of the top of the market off for jeans. But jeans have never really been a workplace wear. And athleisure has some potential to go and replace some workplace wear. I think jeans have always been more about school wear and also evening wear. So when you're going out with friends or you're relaxing at home or just being yourself, you're going to throw on a pair of jeans. So I believe that this plus this thing that I've personally witnessed in my travels to different parts of the world, jeans are aspirational. So in developing economies, sort of the uniform of the middle class is a pair of jeans and a branded shirt, whether that has a European logo on it. Most of the time, it's got an American logo on it. I don't know, off the top of my head, Polo, Ralph Lauren. That is sort of a uniform all around the world that says, hey, I've made it. I'm no longer in the lowest socioeconomic rung. I've climbed up to this other rung here. So I think jeans will continue outside of the U.S. to really play this role in people's fashion choices. Now, in the U.S., I think that's where we may see a little more deterioration in jean sales. And maybe, Nick, that's why we see the wholesale channel in the U.S. suffering a bit. Maybe it's not just the malls and the death of malls that are causing Contour Brands and Levi's to see a little bit of loss of business, but it's this creeping growth and popularity of athleisure. Now, having said that, a lot of the athleisure trend is confined to women. Men, as yet, aren't going en masse in yoga pants outside, but they could potentially in the future. I'll get your opinion on that. So bottom line on your question, yeah, I think that the ultimate market in jeans may be a bit compromised, but I don't see this athleisure trend wiping out jeans. And I think the two will continue to coexist in people's closets.
Yeah, Asad, I think I tend to agree with you. I don't know that yoga pants will be adopted by the male demographic, but I think some level of athleisure is going to and is already beginning to penetrate the male side of the market as well. You mentioned the workplace, and I think that's a really important thing to call out, because I think we've seen a push really across the board at many workplaces to move toward more casual wear. I know we're a very casual workplace here at The Fool. We see folks wearing jeans to work all the time. I think the segment of the market that is really at risk relative to athleisure and maybe even relative to jeans as well is the formal wear side of the market, the Joseph A. Banks, those sorts of things. I think there's just, in 20 years from now, there's going to be a lot fewer people wearing a suit and tie to work than there are today. And I think that opens up market share not only for athleisure, but for Levi's and all these other denim brands as well. These are folks that, casual clothing that folks are really comfortable wearing, on their day-to-day going out and about, evening wear, as you mentioned, Asit. So I do think there's some chance that athleisure maybe tempers the growth of jeans, but I think the real loser here is formal wear. Yeah. So last question, just kind of going away. When you look at these three companies, Levi's, Kontoor Brands, and Madewell, which one are you most excited about as an investor?
I'm most excited about Kontoor Brands. And just, I told you I would talk about dividends. So really briefly, Kontoor Brands, when it gave its pitch to investors, it actually came out and said, we're going to grow our annual revenue 1% to 2% a year. That's not a lot. But they also said, we're going to throw out a dividend which will yield 5%. And I actually wrote an article some time ago during the summer. The company stock fell down to $27 a share. It opened closer to 39 when it spun off in May of this year. And I wrote an article saying, hey, you can pick this stock up today and get somewhere between a 7% to 10% yield on cost if you purchase the shares. They've come back up to that $39 level, but I'm very intrigued. I'm a dividend investor, and for those of you out there who are seeking a stable source of income in a not hypercharged selling environment, this is a very interesting company because, again, they really never had the chance on their own to see, well, what can we do with these brands? They were always under that VF Corp umbrella. Having said that, I'm intrigued by Levi's. You know that Levi's is going to be around a lot longer than you or I will be. Levi's jeans as a brand is going to be here likely another 100 years. They have a dividend, which they just raised, which is now yielding 3.5%. So if you're a dividend investor, maybe you split it between these two companies. But props to Madewell because it is a niche company. Again, it's a fraction of the size of either of the first two, but they've got a handle on this millennial consumer. They are going to grow at a lot faster pace. They'll be a little bit higher risk, but you can't ignore that one either. So I don't want it to make it seem that I don't like Levi's as an investment, and I don't think that Madewell is going to be interesting. We'll have to see it go public, actually, and see a few quarters of performance and analyze those financials, but it's an intriguing aspect. But for my money today, as a dividend investor, and I encourage listeners who are income-seeking investors, check out Kontoor Brands. And you, Nick, I'm very curious where you land on these three companies.
Yeah, I think for me, it's going to be Levi's, just the power of the brand, the staying power. It's a brand that's recognized the world over. When I think of, prestige relative to Wrangler and Lee, it's just a little bit of a notch above. I think when we talked about, when we were preparing for this show, I kind of said Levi's 1A, Wrangler and Lee 1B, the Kontoor brands. I really respect what Madewell has done. I think their growth has been really impressive, and maybe it's my bias, but just because I'm not super familiar with the brand and, I've never purchased anything from them. But I have a perception, and maybe this is an unfair perception, that they may be a little bit more sensitive to fluctuations in what's fashionable from time to time. I like that Levi's has this multi-decade track record of really being that 1A in the jeans market that I think they can persist over time. Really like that dividend though from Kontoor Brands, Asit.
Absolutely.
Well, Asit, always enjoy having you on the show, and we'll look forward to having you on again sometime soon. Thanks as always for coming on.
It's been a pleasure. Appreciate it.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed, so don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Asit Sharma, I'm Nick Seipel. Thanks for listening, and Fool On.